The bond market is in trouble, moving in the wrong direction, showing no signs of a turnaround. We're going to tell you why this is happening and what are the consequences if it continues. Shown here, 10-year US Treasury bond, in this case, the futures. 5 consecutive red candlesticks showing no signs of recovery. Right-hand side, S&P 500. We're very well aware of what's happened over the past couple weeks in the stock markets. On the Treasury side, we've fallen from 114 down to 109. That's a 4.4% decline. During the same period of time, stocks crashed from 5,500 to 4,835. That's 12%. Now, there's two problems with what's happening in the bond market. Number one, treasuries are moving in the wrong direction. Number two, they're not bouncing back. Stocks move opposite the bonds. This is a conventional wisdom. When the stock market, like the S&P 500, moves from 5,000 to 5,500, treasury bond yields move up from 4, for example, to 4.5%. But while those yields are moving up, the actual bond price is falling from 114 down to 109. So when stocks move up, bonds move down, they tend to enjoy an opposite correlation. Shown here on the left as an example, 10-year US Treasury bond futures, right-hand side, S&P 500. From January through pre-crash, we saw Treasury bonds move higher as stocks move lower. This is expected. This is normal. However, since the stock market crash, bond prices have also gone down. This is not normal. Why are bonds moving in the wrong direction? Well, there's a couple reasons we really don't know for sure. Number one, it could be uncertainty over tariffs and confidence in policy. U.S. Treasuries are no longer considered a safe haven. It could be as a result of the tariffs that may lead to inflation. Will the Federal Reserve have to raise interest rates if all the costs for imported goods rise? Hedge funds are also leveraging treasuries and swaps. That's normal. Volatility, however, is forcing the funds to unwind their positions, and as a result, they're selling their treasuries. Also, foreign investors might be selling their holdings overall. U.S. government recently announced plans to issue a new substantial amount of debt to cover the budget deficit. Now, this is not necessarily related to the tariff issue, just an unfortunate coincidence. In addition, China is dumping U.S. treasuries. Now, this could be perceived as an escalation of the trade war, which in turn would force U.S. borrowing costs higher. We're going to talk more about this in just a moment. So why do you think this is happening? What do you think is the reason? Let us know. Treasury bonds are not bouncing back. This is issue number 2. Again, left-hand side, Treasury bond market, right-hand side, stock markets. We've fallen 4.4% on the bond markets. The S&P 500 fell 12%, but we've had some recovery. We're actually only down, believe it or not, 2.5% from the pre-crash level of 5,500. Why aren't the bonds reversing? What is the significance in the surge in yields? Well, we have here in white, that's a 10-year US Treasury yield. That's the yield that we think about, like 4.5%. The red bars show us the change, the weekly change. How much have yields surged? They've surged a lot in the past week. So, for example, in the past week, they've gone up 48 basis points. Now, 100 basis points is 1 full percentage point. So we're talking about half a percentage point over the past week in 10-year US yields. That's actually very significant. The last time we saw a move like this, it moved up 51 basis points, June of 22. That's how long it's been. Before that, we saw a 36 basis point rise in 1 week. That was November of 16. It only happens every once a few years. And before that, well, we have to go back to October 2008. October, in particular, 60 bips, 60 basis points in 1 week. So you can see the significance, and there are other instances, but just to give you an idea about the gravity of the move of what's happened in the treasury market over the past week, that's how significant. We're 10 bips below the move we saw in October of 08. Now, you may ask, what are the consequences of a bear market in bonds? I don't know necessarily we're in a technical bear market, but if this continues, what are the consequences? Well, Associated Press says a freak sell-off of safe haven U.S. bonds raises fear that confidence in America is fading. They say in particular, normally investors rush into treasuries at a whiff of economic chaos. It's always been considered the safe haven of assets. However, they say the fear in the US is losing its standing as a safe haven. Furthermore, that could be bad news for taxpayers paying interest on ballooning US debt, consumers taking out mortgages or car loans. Now, a bear market in bond, there are several specific consequences we should be aware of. Again, it could lead to an increase in borrowing costs, which potentially could exacerbate the US deficits. Also, higher consumer rates. This affects everything: consumer loans, credit cards, mortgages, auto loans at the worst possible time. Diminished investor confidence. It could deter both domestic and foreign investment, impacting overall economic growth. In addition to that, the market volatility could lead to a broader financial market volatility, like we've seen in stocks and commodities. Now, the good news is the bond market also, by the way, right now, at the moment, is the best indicator to look for a sign of cooling, a sign of recovery. Bonds will find a bid, meaning they'll start going up. If the reasons, remember the reasons why this might be going down, we want to see those reasons go away. For example, the uncertainty over tariffs. If this issue is delayed, is okay. We'd like to see a full resolution, though. We'd also like to see a resolution of the idea that tariffs could lead to inflation that could lead the Federal Reserve to raising rates. And even if they don't raise rates, if this postpones a rate cut when we normally might need it, what if GDP gets very soft? What if the jobs numbers get very soft? We want the Federal Reserve to be able to cut rates, not being handcuffed to higher consumer costs as a result of the tariffs. The hedge funds unwinding their positions. We want the hedge funds to go back and start acquiring treasury bonds. We wanted foreign investors to stop selling and maybe start to buy again. And of course, any further escalation of the trade war, that should be put aside as well. So we want the reasons why the bonds are selling off. We want those reasons to go away. And it's very easy to track these because they will be headlines in one source or another. Now, for your general information, if you want to track this on your own real time, super easy. Go to Yahoo Finance or any other financial website for that matter. You can look at either the Treasury bond prices, that's denoted on the left hand side. The symbol is ZN equals F. That's the Yahoo Finance symbol. On the right hand side, TNX. That's the equivalent of the yields of the 10-year U.S. Treasury bonds. Either way, you can track this on your own very carefully and look for some signs of recovery. We'd love to see a green candlestick after the past 5 red ones. We hope this has been helpful. We look forward to seeing you back soon.